So I was trying to put some thoughts together this month. I was trying to come up with something that marries. There's a lot of stuff happening in the news, and I wanted to kind of integrate that with some mechanics of the real estate industry. I guess that's the best way to describe it. And I think there's an interesting takeaway that we can get, or we can see the mechanic being played out right now that I want to call out. And it's about, I want to keep it simple, but it's about the Fed. Whenever people roll their eyes every time we talk about the Fed, and it's hard to get away from it in the real estate industry. It's so directly tied to what the market does. You can't get away from it. And it literally causes real estate booms and busts. It's just this lever that they're able to use to do that. But not for good or bad, whatever. I'm not getting into that. I wanted to try to keep this short and simple to maybe let you understand what's happening just underneath the surface when these big actions, why Jerome Powell and Janet Yellen are so integral to what's happening in this business, right? So let's start with the main thing. So Federal Reserve, I don't want to get too into it. You can Wikipedia this stuff real easily. Federal Reserve is the central banking system that controls, that its mandate is to regulate and stabilize the economy. Whether or not you believe that, I'm not going to get into that. I really do genuinely think they're trying their best, but it's just like a lot of big organizations, they don't do too hot sometimes. Now, they have a few levers at their disposal. Historically, they've been able to control interest rates, and more recently, for the past 12 to 15 years, they've been on this bond buying spree, and not just asset purchases. They're putting things onto their balance sheet to control the cost of debt effectively. So let's back it up a little bit. So let's talk about the controlling interest rates. So the main thing they control is the discount rate, which is the rate at which other banks lend to each other. And why that's important to us is all debt products that we use it's based on what interest rates they're getting with each other. Okay? So why this is super important is mortgage rates. That's the easiest one to think of. So I should mention this too. So if the 10-year T-note is at X, 30-year mortgages are going to be right above that. Now, historically, so this is getting into an aside, so historically mortgage rates go lockstep with 10-year T-notes. The market has found they are comparable to each other, and the 30-year mortgages are maybe a little riskier, and because they're riskier, they deserve a bigger return, but they literally move like this with each other. Look it up. Don't take my word for it. So they control the price of debt, and effectively what this does is they're able to speed up and slow down the economy with this lever. And with mortgage rates, if they raise mortgage rates, it literally it slows down the buying process for the real estate industry. Not slow down the buying process. It just slows down the industry altogether. That's a better way to say it. Now, I'm sure you've heard this a bunch of times. If interest rates go up 1 percentage point, your buying power gets reduced by X or whatever. Now, that's true. So let's say it goes up. Let's say your interest rates go up a one percentage point. So instead of being able to get a 2.5% 30-year mortgage, now you can do a 3.5, and your buying power goes from, if you're in Austin, your buying power goes from 500,000 down to 450, something like that. Now imagine that so when they raise interest rates, everybody's buying power is reduced by that amount. So let's use that as a round number. So 1 million properties, being reduced by $50,000. That's $50 billion worth of buying power that the real estate economy has been reduced by. That's why this shit is important. Is if it goes up that much, the real estate economy contracts by by billions of dollars. That's why this, these guys watch this stuff like a hawk. And the more over leveraged our industry is, the more sensitive to what the Federal Reserve does. Does that make sense? I hope so. So right now we're leveraged to the gills, and because of this health crisis that's been going on, the Fed, in order to keep the cost of debt cheap for the federal government, they've been buying bonds to keep treasuries and bonds down at an artificially lower level, to keep our interest rates really, really low. Like, this is, once in a lifetime. Like, you're not going to be able to buy debt or get a mortgage this cheap ever again. So they're buying down the debt. 2 weeks ago, Jerome Powell had announced that they're finally walking back this bond buying program. Okay? Again, I'm hyperlinking everything I'm saying, which is crazy, but hopefully this makes sense to you guys. And why this is important is this buying pressure has artificially kept interest rates low in the bond market, which has kept mortgage rates low. And now that this $80 billion a month pressure is being slowly lifted, and I'm sure they're gonna, if the market overreacts, they might step in and come in and still buy more to keep the interest rates down. But the expectation is interest rates should go up if there's not that $80 billion a month buying pressure to keep those rates bought down low. So the takeaway is there's an expectation for interest rates to go back up if there's not enough buying pressure from the rest of the economic community, or I don't even know who else. I guess just these macro institutional investors. My speculation, it feels like, and so I don't have the best enough handle on this, but this Evergrande crap that's been happening in China, they're trying to pull out their assets and throw their money into something right now. So there's demand for U.S. dollars, U.S. bonds again because of this exodus of money that's trying to find a safe place to hide their money. I think this is partially related to that. I don't have it. It's pure speculation. I don't know if there's any articles on that. I know there's demand for U.S. dollars in the East right now. So, okay, if there's anything to take away from this, interest rates, mortgage interest rates follow the 10-year treasury historically lockstep. And so if the bonds are down, interest rates are going to go down. If bond rates go up, interest rates for mortgages are going to go up as well. So, anyways, if you guys have any questions, let me know. Just want to do a short little ramble about this, and yeah, that's it. Thanks.